Welcome to the BF Anderson Technical Report for December the 1st. November has been a very volatile month. October was a very difficult month. Everything went down about 5% going into the election. Now we're starting to see some breakouts of the major indexes out there. I mean the Dow, the NASDAQ, the S&P, and so forth. But this is a particular index that I want to call to your attention. This is the Value Line Geometric Index. Now this index is equally weighted, which means that Apple, which is a $650 billion company, would be carried at the same weighting in the index as, let's say, Intel, which is a $150 billion company. So there's every index out there that the media uses on television, and they never talk about this one, is market cap weighted. So what happens is that you get a real emphasis on the large companies, and you really don't get to see what the average stock is doing. Now this index is a 1700 stock index. I believe it to be a true metric of the broad market due to the fact that it's equally weighted. So you want to understand the term market breadth. Market breadth is, how is the average stock doing overall? The problem with the market for the last 3 years has been it's been led by just a few stocks, mainly the FANG stocks, Facebook, Amazon, Netflix, Google. That has been the leadership of the market, so it's been very concentrated in just a few areas. Now, this particular index, since 1998, hit a high of 510 back in 98, dropped all the way down to 150 in 09, and then is just now getting to the point of possibly breaking out here. Now this would be an extremely bullish indication, because so far with the rally that we've been having, it's been primarily concentrated in financials and energy and metals and mining and things like that. Well, we want to see the market itself, the breadth of the market, expand to get more stocks moving. Now one other note I want to make here is that if you go back and study the Great Depression, and for years in this business, every year I hear we're going to have a depression. This drop, the only drop that I can find that comes close to this was in 1929 in the Great Depression. Now realize the market really didn't get going again until around 1946. So if you go back and you say, okay, well the market pretty much peaked back here in 98, which we're talking, many years here to get back to where we were in 98. So this indicator, if it breaks out above, say, 510, 520, I think that's going to be a very positive sign. Now, the group that is catching my attention the most, and I think we need to really pay attention because this is very healthy. This is the Russell 2000 Small Cap Index. Now, if you realize here, during the first part of this year, this index dropped 27.2% and has basically been in a 17-month bear market. So the thing to realize is that very difficult markets, which 16 has been, and 15, are usually followed by easier markets. So where we've had a really difficult time here, and it looks like to me that things are breaking out and the small caps are leading. Now, I want to take a minute and answer the question based on history, whether or not rising interest rates are going to hurt us. Well, let's look at what's going on right now with interest rates. As you can see, since 07, 08, rates have dropped from their long-term average. Now realize the average yield on the 10-year Treasury for the last 200 years is 5.18%. Now it's not only the level of the yield, but it's the direction of the yield. So if rates break, based on my studies, if rates break below 5%, which is the long-term average, and start heading downward, it means that the market is real concerned about deflation. So the defensive type stocks, the bond market, so forth, will benefit from that. So you can see here that rates have dropped dramatically and actually got down to a double bottom low here around the 1.3, 1.4 area for the 10-year. Now, it looks like we're shifting direction here. And a recent report by Louise Yamada, who is a technical analyst, says that she believes that we're going to break above 2.5 and this morning we're at 2.4, which is right here. If we break above 2.5, that 3% is really not out of the question. So the chances of higher interest rates seem to be on the table, and we need to be aware of it. Now, if we go back and look at the market itself currently, from mid-2015 to 16, it looked pretty much like a bear market to me. I mean, this drop here was quite dramatic, and it looks like we kind of shook everybody out. But we're starting to see, higher highs on the S&P, and the 200-day moving average has turned up. So the market does look healthy. Now, if we look at history and just try to get a handle on interest rates here, if we go back to 1993, which was a period where interest rates did climb, this would be an example of rising interest rates. So during that time period, the Russell 2000 climbed 22%. Now, if we look at what happened with interest rates, the 10-year during that same time period went from a low of 5.2 to a high of around 8%. So during this period where rates are climbing, is the market, the small caps like that, because it's basically, think about it, the dollar is strengthening. You want to stay with domestic companies. Most small cap companies, I would say 80% of the Russell 2000 is small cap companies that are domiciled in the United States, so you don't have to worry about your export market as much. Also, most small cap companies do not carry a lot of debt, and therefore interest rates really do not affect them if they rise. So then if we also look at the 2-year yield, 2-year Treasury bond during the same period, you can see that rates climbed quite dramatically, went from 3.7% to 7.7. Take another example. All right, this is the Russell in 2003 till 2007. The Russell moved up 150% during that time period. Then if we look at the 10-year again, the 10-year went from 3.15 up to 5.25, back to the old 200-year average. If we look at the 2-year, you can also see a dramatic up move in the 2-year yield as well. Now, some other points of interest. This is the Dow Jones Transportation Index. Now, there's a theory out there called the Dow Theory that says very simply that if the Dow Jones Industrial Average, which is 30 industrial cyclical companies, if that index hits an all-time new high, for a Dow Theory to give a buy signal, the transportation index has to break out and hit a new high as well to confirm the industrials. Logically, here's what the thinking behind it. The industrials is mainly manufacturing companies, and if they're manufacturing and everything's sitting on the shelf, that's not good. But if the transports break out, it's telling you that the goods are moving around the world, and that's very positive. Another point here, this is to kind of show you where we have been here. If you look at 2011, 2013, we moved sideways for about 2 years, and it really was a very frustrating period. I can remember many clients having serious problems during this drop here. Then right at the end of the year, and I'm talking December 31st, this index, which is the Russell, broke out and went into a major up move. Our portfolios moved up dramatically between this point here and this point here. Then we started to form a 3-year top, which we think pretty much bottomed here, and we think a new bull market got started right around here in July. So now the Russell's breaking out, looks good. Now I wanted to mention a particular stock. This is Charles Schwab. This is what I would call a bull market stock. If you go back to 1999, the stock got up to around $40 a share. Then during the bear market of 03, of 2000 to 03, the stock dropped all the way down to about $5 a share from 40. It has taken Charles Schwab 16 years to get back to the old high that was set back in 99. So this is very comparable to the 1946 to 1968. 46, the market started to climb, and the war was over. Everybody was coming home. Interest rates started to go up. The market peaked in 68 and then dropped from it hit 1,000. The Dow hit 1,000 in 68. Then by 74 was down to around 500. So it lost about half its value. and then hyperinflation kicked in, and that was the big problem. But we bottomed in 74, and then we got back to 1,000 in 1980. So we're talking about a significant amount of time. But in 1980 we launched a major bull market that really ran for about 20 years. So I believe that Schwab is a bull market stock. You can go look at all the brokerage firms. You can go look at all the financials. They're all breaking out. This is a very interesting situation. If you have any questions, give me a call. Thank you.